Welcome to the Tooth and Coin podcast. I'm Jonathan Van Horn, CEO of Tooth and Coin, a CPA firm helping about 400 dental practices across the country navigate the complex world of business and taxes. In today's episode, we're diving into a topic that's causing waves across dental forums and social media groups. It's a story I've seen play out time and time again. Imagine this. You've just bought your first dental practice, the ink on the lease is barely dry, and you're feeling like Rose on the front of the Titanic. And bam! Your first tax estimate arrives. Suddenly, you're feeling less like the king of the world and more like you're watching the iceberg approach in slow motion. Titanic reference in a dental tax podcast? Yep. Anyway, this scenario, a new practice owner blindsided by their tax estimate, it's all too common. It's a financial plot twist that can turn your practice dream to a bit of a nightmare. But don't worry, old Jonathan's here to help you navigate these choppy waters. And while this episode will be geared towards newer practice owners, I'll make sure to include advice for established practices too, so buckle up. We're going to be breaking down this tax conundrum piece by piece and cover the following: the tax shock new and established practice owners alike often face, why it happens and what to expect, the crucial difference between tax estimates and projections, along with the secret that the IRS doesn't want you to know. Once you know how much you are going to pay, what do you do next? We're going to explore the good, the bad, and the downright ugly world of tax strategies. We're going to look at how to spot a legitimate tax professional, because not all heroes wear capes, some do carry calculators. And finally, the Tooth and Coin approach to tax planning, our blueprint for steering clear of financial icebergs. So grab your life vest or your favorite pair of dental loops, and let's dive deep into the world of dental taxes. By the end of this episode, you'll be better equipped to navigate your practice's estimated taxes than Rose was at sharing that door. That's 2 Titanic references. Nailed it. But trust me, there's room for both you and your profits on this episode. The ultimate question being asked here is, why is your tax estimate higher than a patient with a lifelong fear of dentist? And it's complicated. And the easiest way for me to break this down is to look at the 4 different types of practice owners that face this problem. And so here they are. 1 is going to be startup practices. 2 is going to be people who have acquired practices. 3 are going to be established practices that are facing changes. And 4 is going to be just established practices without a whole bunch of changes going on. So first, let's talk about the startup practice owners and when they typically end up feeling this way about their tax estimates and things like that. So if you're starting a practice from scratch, you might have more in write-offs than you expected. Equipment purchases, build-out cost, leasehold improvements, all of these things can be written off, often through accelerated depreciation, bonus depreciation, etc. And it's not uncommon for the amount of depreciation to reach into the multiple 6 figures. So here's where it gets tricky. The amount of taxes you're going to owe is going to depend on a bunch of different factors. That is going to be, number 1, your growth rate. If you're a super fast growing practice, you might still end up with a hefty tax bill, even though the average startup doesn't owe much in their first year. Because just imagine the differences. We've had clients that have had up to 250 new patients in a month, and they're going to bring in probably more than, $1 to $2 million in revenue in the first year. And that means that they're going to have a bigger tax bill than the average startup practice who just sees 35 new patients a month and is lucky to break even in their first 12 months or hit even the $400,000 mark. So there's just big differences. Growth rate really affects how much you're going to be on there. 2 is timing. So when you become a practice owner matters. If you start your practice in January and you've got a full year of income with a longer ramp-up period before the year ends, compared to starting in December and you've only got 1 month of income, but the same giant bump in equipment write-offs as the person who opened in January, then that's going to affect things. And this is why you should open your startup prior to the first of the year, if you can, if number 3 applies, which is the third one, and that is other income sources. So if you were working as a 1099 contractor earlier in the year before starting your practice, that income will affect your overall tax situation. So just as an example, let's say you made $300,000 as an associate somewhere else prior to opening in December. Now you can offset that income with your startup if the entity and everything is structured correctly. So it's important, and that can affect how those things affect your tax estimates. So now that we've talked about that, let's talk about the issues that go for people that are doing acquisitions. And I'll say that if you face mega growth after an acquisition, the time of the year that you purchase and the other income sources pieces that hit startups, they're all still play in the acquisition. But depending on what type of practice you bought, unlike startups, it's quite a bit more predictable if you're going to be generating very much income from day one with an acquisition compared to a startup. There's just a practice that cash flows $50,000 a month doesn't usually stop doing that once a new practice owner takes over. This means that you might not have the same level of initial losses to offset your tax liability as a startup would. The amount in write-offs for hard assets that can be depreciated is usually a lot less in an acquisition than when doing a startup. So like a typical startup can have anywhere from $300,000 to $600,000 in hard assets to use, with that accelerated bonus depreciation 179 compared to like if you bought $1 million practice, that practice could have as little as $100,000 in hard assets. And now the remainder of the purchase can go to goodwill, and that can be amortized over a 15-year period, but you don't really bank on that as a first-year owner. So that is a piece that affects how much you're going to be paying in those estimates. So moving off of acquisitions into existing practice owners, because they're not immune to tax surprises either, I break those down into two categories. The ones facing a lot of change. And so the reason you're facing change is because you have growth spurts. So maybe you've added a new service like Invisalign or sleep apnea, and suddenly your revenue is shooting it faster than a patient's hand when you ask if they floss daily. This growth can push you into a higher tax bracket because all of a sudden you've got this extra incremental income, and that means you have higher tax estimates. Major investments, if you've made significant equipment purchases or renovations, you might see a decrease in your tax bill due to depreciation. But remember, it's a double-edged sword because it's going to be a lower tax bill this year, and that can make you feel a false sense of security whenever you find out next year how much you're going to owe. Other things that can affect it, bringing on new staff, associates, et cetera, those things can really change your cash flow, which means your tax situation can change also. If you're an established office and you're not seeing all these big changes, it still is a bit more predictable usually of what you're going to be paying on a consistent basis, but don't fall into the trap of thinking it's going to be exactly the same every year because it sometimes isn't. Even practices that are established and somewhat static, they still sometimes have modest growth year over year, and that can move you into higher brackets as time goes on. It's like dental calculus, like a little buildup over time can suddenly become pretty noticeable. Finally, just changes in tax laws will affect things. So even if nothing changes in your practice, changes in the tax law will change your liability sometimes. At the end of the day, whether you're a new practice owner or you've been at it for years, your tax situation can be really complex and full of surprises. And it's crucial to work with a tax person who understands your specific situation and the dental industry. There's just so many times we've seen clients come in from other providers who got advice from someone who just had dental clients. And it was just a person who, they were doing their best, but what they did is they applied the other dentist situations to that dentist situation. But it's more varied than that. I just gave you all these different reasons why numbers can change and estimates can be off and things like that. This complexity and potential for surprises is precisely why tax estimates can be so shocking for practice owners, both new and established alike. Now that we have some of the reasons on why these surprises happen, let's talk about the difference between a tax estimate and a tax projection so that we can delineate between the two and you can understand the difference. Okay, so we've talked about the definitions. We've talked about when different types of practice owners get into these surprises. Now let's talk about the numbers high. What can we do about it? Well, this is where tax strategies come into play. And just so you know, for this episode, I'm not going to be just talking about tax strategies. I'm going to have a lot of content to talk about tax strategies in the future. So subscribe, make sure that you're, get notifications on everything like that to be able to hear those things. So remember those big surprises we heard about earlier? Well, let's talk about how to really affect those with those strategies. And let's define what a strategy actually is. So a tax strategy is a legal method to reduce your tax liability. We're not talking about like hiding income or fudging numbers or being fraudulent or anything like that. Instead, we're talking about the tax code and using it to your advantage. Think of it like using the right burr for a crown prep. You're not changing the fundamental procedure, you're just optimizing your approach. And at Tooth and Coin, our average tax strategies, whenever we put everything together for a client, saves around $60,000 to $70,000 for an established office. And so like over a 10-year period, that's a lot of money. It's $700,000. And if you think about the fact that you could probably just go put that in another investment somewhere, it could be even worth even more when you get down the line. So it's a lot of money. It's kind of like the difference between treating decay early or waiting until you need a root canal. Addressing it sooner can save you a lot of money in the long run. A lot of people have heard of tax strategies, and some people think that there's like really secret ones and like magical things that can make your tax bill just kind of disappear. But like most things in life, if it's too good to be true, it probably is. A legitimate strategy is often going to involve leveraging specific parts of the tax code to your advantage. As an example of this, there's ways to use like your personal property for business purposes that can provide tax benefits. And there's retirement vehicles they can offer throughout your practice that can help with deferring taxes. And the key is that these strategies are all above board and explicitly allowed by the IRS. Even though there are some good ones, there's also some red flag ones out there that aren't really even real. So be aware of any strategies that sound too good to be true. Be aware of any tax advisor that is pushing investments as tax strategies. Make sure that if anybody's claiming to have a secret strategy that the IRS doesn't want you to know about, that's something to be a red flag. And finally, if anyone's selling you an investment and calling it a tax strategy, you should really be questioning their motives. They might be making money if you invest in that thing, regardless of whether it's actually beneficial for you. So it's kind of like a lab pushing a particular material because they get a kickback, not because it's like the best one for your case. I'm just trying to put these warning signs out there so that you can understand that they can save you significant amounts of money, but they require careful planning, proper implementation, and often ongoing management. So be wary of anything that sounds too good to be true, and always work with a professional who can guide you through the complexities of tax planning. So you're looking to implement strategies, you got to go find the right tax pro. And, it's hard. It's like finding the right specialist for a complex procedure. You want someone who's got the right credentials, the right experience, and the right approach for your situation. But in a world where everyone claims to be an expert, how do you separate the wheat from the chaff? Well, let's break it down. First thing I tell people to look for when they're looking for someone to help with this problem is to look at social proof. If there's a lot of other dentists referring you to a specific place, that's a good sign. It's like getting a referral for a good orthodontist, minus the free toothbrush. But remember, just because someone has dental clients doesn't always mean that they truly understand the unique aspects of dental practices. 2 is their credentials. Make sure that they have CPA license, an EIA, or they're a tax attorney. People that get those credentials, they have to take tests similar to dental boards. And that's saying something because they're held to ethical standards. As a CPA, I don't want to lose my license. I worked hard to earn it. And the same goes for most attorneys and EAs as well. Make sure that they have experience with dentists. Ask how many dentists they work with and for how long they've worked with them. You want someone who understands the nuances of dental practices, not someone who's just dipping their toes in the water. If they say that you're their first dental client, be a bit more critical. 4th thing I say is make sure that they're willing to sign tax returns. It's really crucial. If they say they'll show you strategies, but won't sign your tax return, that's a red flag bigger than the exit sign in your waiting room. Here's one. When you file a tax return, you're ultimately taking responsibility for what you're telling the government. If your return is wrong, then you as the taxpayer are on the hook. A professional who signs your return is saying to some degree, I prepared this and the information that they presented to me at least appears reasonable. So there's going to be some level of responsibility and accountability to the person who's the professional that signed the return as well. 5th thing is no investment pushing. Be very cautious of anyone pushing investments as part of their tax strategy. If someone's selling you an investment and calling it some complex tax strategy, it's probably an ulterior motive. And that person may be getting a kickback for doing all this for you. And that's not good. That creates a bias. And let's just talk about investments for a minute. So any investment that you make through your business or for yourself personally, it should be financially sound first and foremost. The tax benefits are always secondary. I mean, for years, people have talked about whole life insurance being sold as a tax strategy, and everybody's critical of that. But now all of a sudden, we're seeing these new waves of investments being pushed that are given under the guise of tax strategies. There's things like real estate syndications, ATM, short-term rentals, oil and gas things. And just because something offers a good tax benefit doesn't mean it's a good investment. So remember, if you lose money on a bad investment, the margin to have tax savings make up for that loss is so razor thin, it's not going to be worth the risk. So be super, super aware of that. Here's another real world example. Since I'm a CPA and have the word tooth in my Facebook profile, I get ads served to both dentists as well as accounting people. And I've seen ads on Facebook selling tax strategies to dentists and even selling tax strategies to people in the accounting field to sell to other people. And some of these people aren't even tax professionals themselves. They're just selling the idea of being a tax strategist. In other words, there are non-professionals that are out there selling courses to other non-professionals about how they can offer tax planning services to dentists. They're just using templates and software. And I'd be surprised if most even know what the Internal Revenue Code is. So that'd be like someone watching a few YouTube videos and then offering to do molar endo. It's dangerous and likely to cause more harm than good. Another red flag is if someone's charging you a large fee. Like I've seen up to $30,000 tax strategies out there to show you tax strategies without doing your returns, not doing your accounting, or doing any other services. Be really, really wary. That's a lot of money for advice. and I've yet to see a plan that has some unique thing that was inside of it for that price tag. A legitimate tax professional should have the right credentials, extensive experience with dental practices, and be willing to stand behind their work by signing your returns. They should offer you more than just a piece of paper with some strategies on it, and they shouldn't be pushing you investments. So remember, if it sounds too good to be true, it probably is. Your tax professional should be as trustworthy and as reliable as your favorite dental assistant. They're to support you and help you succeed, not to sell you something that you don't need. So let's talk about how different firms approach tax planning, because not every firm does it the same way. First, the most common way is that there's no planning done whatsoever. Tax planning actually wasn't really a thing until in the last 10, 20 years or so. So most CPA firms were set up to just give you your tax returns, take your stuff in, prepare the return, send it out. That's the reason most CPA firms are around, how they traditionally would do work. So the most common is just not doing any planning at all. The second most common is to do what I call the end of year scramble, which means that the firm is just going through at the end of the year and saying like, hey, we think you're going to make a couple $100,000 this year. You can spend some money to buy equipment and you'll pay less in taxes. That's great that something's being done with that, but at the same time, that could be bad advice too. Because if you didn't need that piece of equipment, then why did you buy it? It may end up costing you money. You can't spend your way out of taxes. So that can be really negative in some ways. Because remember, it's the same rules with investments. You should be buying a piece of equipment because you need it as a positive return on your capital to be able to create more revenue and more profit and things like that. You shouldn't be buying it to save money in taxes. For some firms, that's all of their tax planning that they do. And that's not really the current definition of tax planning, how a lot of practices do it now. After that, there's what I call the top 3 category of planning, which is where the CPA just tells you, hey, here's the most influential things that you can do this year. Like there's 3 things, and do 1, 2, and 3. And we'll see you next year because you'll save some money in taxes on that. That's a pretty good method of doing it. We actually used to do that in our firm for a while. But what happens is that when we tell a client to do those 3 things, maybe they do 1 or 2 of them, but they don't do the third one. And then we then have to slowly introduce the new items after those are done. And it becomes a really long and drawn out process to where there are some opportunities that the client may lose because we didn't tell them everything because we didn't want to overload them with all the stuff to do. And so that does work in some ways, but there's just negatives to it. And the biggest negative is that the client doesn't get to do any type of understanding themselves of if, hey, are we leaving money on the table? And also, it's not uncommon that those top 3 category of tax planners, sometimes all they do is those 3 things. They don't ever tell them anything else because they're like, oh, I gave you the biggest chunks, and they just leave all this money on the table. So it can cause a little bit of a mess. Then there's kind of the newer way of doing it, which is the way that Tooth and Coin does it. And that's that we do a comprehensive analysis of all of our clients every year. We make sure to look at the prior year tax returns. In the case there's something that's came out in the tax law that might be retroactive in nature, we make sure that we have a really good understanding of their situation, both professionally and personally. We look at their future plans. We look at all their investments and things like that. And we just look at the client as a whole. And then we put in front of them all the opportunities we think that they may have to lower their tax burden. Our typical client will get somewhere between 10 and 15 opportunities presented to them each year. And each opportunity comes with like a list of resources and guides and information to be able to have a step-by-step analysis of like what they need to do in order to make their reality real to where they can qualify for that opportunity. Because you don't get to just say, hey, I qualify for this opportunity. Now give me my free money. There's things that have to be done. And so we have to educate our clients on how to do that. And then at the end of the day, it ends up kind of looking like a restaurant menu. So you got the 10 or 15 items on the left. You've got 10 or 15 numbers on the right. You do the items on the left. You save the numbers on the right. And that's how we can track our effectiveness of our tax planning. And that's how I can, very confidently say that we save our clients between $60,000 and $70,000 a year. That's how we do that. Remember, good tax planning is like good hygiene. You've got to be consistent. You've got to keep doing it every year because things do change. And that is how you unlock all that money in tax savings. In this episode, we've talked about the big tax shock that comes with estimates sometimes. We talked about, what types of practices typically face it and why they face it. We've talked about the definitions between tax estimates and tax projections. We've talked about how to understand what strategies are. We've talked about how to find a tax pro. We've also talked about how different CPA firms plan for taxes and do tax planning for clients. And tax planning might seem complicated, but it's crucial for running a successful dental practice. So make sure that you're working with someone who knows your industry and can guide you safely and legally. So remember, if a tax strategy seems too good to be true, it probably is. Thanks for tuning in to the Tooth and Coin podcast. Let me know what you thought about this episode. It was a new way for me to do it. I scripted pretty much everything in it, and I'm eager to understand what you guys like about it and what you don't. Do you prefer more scripted content, or do you prefer it to be a bit more off the cuff and a bit more conversational in content? Finally, if you have any other questions or you want to learn more about how our firm can help you optimize your tax strategy, reach out. Head over to toothandcoin.com and register for a tax consultation to see about how we help dental practices thrive in this environment. Thanks for your time. And until next time, keep smiling and have a good day. Thanks for listening to the Tooth and Coin podcast. If you enjoyed the show, we'd really appreciate it if you could leave us a 5-star review as well as a written review. Your feedback not only helps us improve, but also helps other dental professionals find our podcast and benefit from the financial insights that we share. So thanks for your support, and we'll catch you in the next episode where we'll continue to explore the business side of dentistry.